In 2026, the most dangerous word in global finance is not recession, crash, or collapse. It's paralysis. What we are facing is not a replay of 2008, and that distinction matters more than most people realize. Back then, the system broke because trust evaporated. Banks stopped lending, markets froze, and liquidity vanished almost overnight. But there was a release valve. Central banks could flood the system with money, governments could guarantee assets, and once fear subsided, movement returned. What's emerging now is something far colder and far harder to reverse, a liquidity trap where money technically exists, but no longer flows in ways that restore stability. To understand why 2026 is different, you have to let go of the idea that crises always look like sudden explosions. This one looks more like suffocation. Liquidity traps are defined by a simple but brutal reality. Injecting more money stops producing meaningful effects. Capital piles up in safe assets, government paper, reserves, and balance sheets, while the real economy remains starved of functional credit. The tools that once restarted growth no longer work because every intervention creates a new risk somewhere else. Lower rates don't stimulate borrowing. Higher rates threaten insolvency. Spending more fuels inflation or political backlash. Spending less deepens stagnation. Every lever is connected to a tripwire. What makes 2026 fundamentally different is that the system is already saturated with emergency measures before the crisis has even fully revealed itself. The extraordinary has become normal. Massive deficits are routine. Central bank balance sheets are permanently bloated. Markets no longer react with surprise to trillion-dollar numbers because those numbers have lost their signaling power. Liquidity isn't scarce in absolute terms. It's misaligned, trapped in places where it cannot translate into productive risk-taking. The result is a financial environment where movement itself becomes dangerous, so institutions choose stillness. This is where the trap tightens. In a liquidity trap, confidence doesn't collapse all at once. It erodes selectively. Investors grow unwilling to take duration risk. Banks grow unwilling to expand credit. Governments grow unwilling to tolerate short-term pain. Each actor behaves rationally in isolation, but collectively they produce gridlock. Capital waits, policy hesitates, markets drift, not because nothing is wrong, but because everything is fragile. The system keeps functioning just enough to avoid panic, but not enough to restore momentum. The climax of this dynamic is not a dramatic crash, but the realization that there is no clean exit. In 2008, intervention created a floor. In 2026, intervention becomes the ceiling. Every attempt to force liquidity back into motion risks destabilizing something larger: currencies, sovereign debt, political legitimacy, or geopolitical balance. The crisis is not that money disappears, it's that money loses its ability to heal. And that is the defining feature of the 2026 liquidity trap. A system still standing, still trading, still issuing debt and policy statements, but quietly locked in place. No collapse to rally against, no panic to resolve, just a slow recognition that the old crisis playbook no longer applies, and that this time the trap isn't waiting to be escaped. It's already closed. In 2008, the crisis had a clear center of gravity. It lived inside the financial system itself. Leverage was excessive, risk was mispriced, and when housing prices turned, the machinery of securitization collapsed under its own weight. Banks didn't stop lending because money was useless. They stopped because they no longer trusted the collateral or each other. Liquidity vanished not because it failed as a concept, but because fear shut the doors. Once that fear was confronted through guarantees, capital injections, and aggressive monetary easing, the system could breathe again. Credit channels reopened, markets stabilized. The damage was immense, but the mechanism was legible. The conditions implied in 2026 are not legible in the same way. There is no single asset class imploding, no obvious bubble popping, no moment where the system breaks and then waits to be rescued. The architecture itself has changed. In 2008, central banks were outside the fire, stepping in as emergency actors. In 2026, they are embedded in the structure. Balance sheets that were once temporary interventions are now permanent features. Interest rates that were once emergency settings are now political variables. The boundary between markets and policy has blurred. to the point where it is no longer clear where one ends and the other begins. In 2008, liquidity was the cure. The system needed capital, and once it arrived, it did its job. In 2026, liquidity is no longer scarce, it is inert. Capital exists in vast quantities, but it is parked, hedged, sterilized, and defensive. It flows toward safety rather than growth, toward preservation rather than expansion. This is not a failure of supply, it is a failure of transmission. The channels that once converted liquidity into risk-taking, investment, and productivity are clogged by structural constraints that didn't exist in the same way in 2008. Another crucial difference is time. The 2008 crisis unfolded rapidly. The shock was violent, the response was decisive, and the resolution, while painful, followed a recognizable arc. The 2026 environment is defined by duration. Problems accumulate slowly. Policies are layered on top of one another, and each solution carries long-term consequences that narrow future options. Debt levels are higher. Demographics are less forgiving. Political tolerance for austerity is lower. Global coordination is weaker. These are not cyclical issues. They are structural conditions that persist regardless of short-term interventions. The climax of this contrast lies in agency. In 2008, policymakers acted from a position of relative freedom. They could cut rates dramatically, expand balance sheets, and absorb political backlash because the alternative was visible catastrophe. In 2026, every action is constrained. Cutting rates risks currency instability. Raising rates threatens sovereign balance sheets. Expanding spending fuels inflation or populist revolt. Restraint invites stagnation. There is no clear villain to blame and no singular lever to pull. The system is not broken in one place, it is stretched everywhere. This is why the next crisis cannot look like 2008. That crisis was about repairing damage. The conditions of 2026 are about navigating permanence. The mechanisms that once delivered recovery now generate trade-offs instead of solutions. The danger is not that the system collapses overnight, but that it remains operational while losing its capacity to correct itself. And that difference changes everything about how this crisis unfolds. The danger in the current system is not that it breaks suddenly, but that it cannot move without breaking something else. Traditional collapses occur when a weak point fails and the pressure releases violently. What exists now is different. The constraints are everywhere, layered over years of crisis management, political compromise, and institutional self-protection. Each one on its own seems manageable. Together, they form a closed circuit where stress has nowhere to go. Start with monetary policy. Interest rates were once a powerful steering mechanism. Lower them and borrowing increases. Raise them and excesses cool. That relationship has degraded. Rates today are not just economic tools, they are political signals, fiscal anchors, and financial tripwires. Governments carry debt loads that assume stable or declining borrowing costs. Financial institutions hold balance sheets priced for a world where rates do not spike unexpectedly. Households are already stretched. In this environment, aggressive rate cuts risk currency weakness and inflation resurgence, while aggressive hikes threaten insolvency cascades. The central bank is no longer choosing between growth and inflation. It is choosing which pressure point fails first. Fiscal policy is no freer. Deficits have ceased to be temporary responses to emergencies and have become structural features of governance. Spending is locked in by demographics, entitlements, defense commitments, and political promises that cannot be unwound without backlash. At the same time, higher borrowing costs make additional spending increasingly expensive, not just financially, but psychologically. Markets watch issuance closely. Voters watch inflation closely. The room to maneuver narrows until stimulus no longer feels stimulative and restraint no longer feels responsible. The state continues to spend, but each dollar delivers diminishing stabilization. Then there are the institutions themselves. Banks are better capitalized than they were in 2008, but they are also more constrained. Regulation has made them safer individually and more cautious collectively. Risk is pushed outward into shadow banking, private credit, and market-based finance that lacks clear backstops. This creates a system that appears resilient on paper, but fragile in motion. When volatility rises, these actors do not absorb shocks, they withdraw. Liquidity doesn't vanish in a panic, it quietly steps aside. Markets reflect this paralysis. Price discovery becomes distorted not by euphoria or fear, but by absence. Trading volumes thin, volatility clusters without direction, capital rotates defensively rather than productively. Investors are not convinced enough to commit, but not frightened enough to flee. This is not collapse behavior, it is waiting behavior. Everyone knows something is wrong, no one knows where to stand. The climax of this trap is reached when intervention itself becomes destabilizing. Announcements move markets more than actions. Silence becomes a signal. Every policy decision is interpreted as confirmation that constraints are tightening. The system responds not by breaking, but by stiffening. Movement slows, adaptation stalls. The feedback loops that once amplified recovery now reinforce hesitation. The resolution is not relief, but recognition. A traditional collapse resets expectations through destruction. This environment does the opposite. It preserves structures while draining them of flexibility. The trap is not a dramatic failure. It is an enduring condition where the system survives by avoiding decisions that would restore dynamism. And that is why this moment does not resolve in a crash. It settles into place, heavy, immobile, and increasingly difficult to escape. For decades, crisis response followed a familiar script. When markets seized, central banks cut rates. When credit froze, they injected liquidity. When confidence cracked, governments spent aggressively and promised to do whatever it took. Those tools worked because the system still responded to pressure. Push here and something moved there. Under the current structure, that relationship has broken down. The tools remain, but their effects have dulled, distorted, or even reversed. Take interest rates. Lowering them once encouraged borrowing, risk-taking, and investment. Today, rate cuts are often interpreted not as relief, but as warning signals. They tell markets that conditions are worse than expected, that growth is weaker, that hidden stresses exist. Instead of unlocking credit, cuts can reinforce caution. Capital flows into safe assets, not productive ones. Savers pull back, banks tighten standards. The intended stimulus becomes a psychological break. Quantitative easing faces a similar problem. Expanding balance sheets used to flood the system with liquidity and compress risk premiums. Now, additional asset purchases struggle to escape financial markets at all. Liquidity circulates within a closed loop of reserves, government bonds, and large institutional balance sheets. It inflates prices, but not confidence. Asset values rise without generating the real economic momentum that would justify them. Each new round delivers less impact while increasing the sense that markets are being artificially propped up. Fiscal stimulus is no longer a clean counterweight either. Large spending packages once signaled decisive action and future growth. In the current environment, they trigger a different calculation. Investors ask who will fund them, at what cost, and for how long. Households ask whether spending today means inflation tomorrow. Governments find that every attempt to stimulate demand collides with supply constraints, political resistance, or debt sustainability concerns. Spending still happens, but it no longer resets expectations. It merely shifts pressure forward. Even regulatory tools fail to behave as intended. Safeguards designed to prevent panic now slow adjustment. Capital requirements, liquidity buffers, and stress tests make institutions safer individually, but less willing to act collectively in moments of uncertainty. When stress emerges, the system does not absorb it, it freezes around it. Stability becomes rigidity. The climax of this failure is reached when every familiar lever produces side effects larger than its benefits. Policy announcements move markets more than policy actions. Credibility erodes not because authorities lack power, but because they have already used so much of it. Each intervention confirms that the margin for error is shrinking. The resolution is stark. Conventional tools fail not because they are misused, but because they were designed for a system that no longer exists. They assume elasticity, trust, and unused capacity. What they face now is saturation, fragility, and constraint. In this structure, response does not restore motion. It exposes how little room remains to maneuver. An unstoppable crisis does not announce itself with sirens or headlines. It settles in quietly, reshaping behavior long before it is officially named. For markets, the implication is not dramatic collapse, but a prolonged distortion of signals. Prices stop reflecting future growth and start reflecting survival. Volatility no longer clears excess, it lingers. Capital allocators become custodians rather than risk takers, prioritizing preservation over expansion. Liquidity exists, but it circulates defensively, reinforcing asset concentration and widening the gap between financial markets and the real economy. The result is a market environment that appears stable on the surface while growing increasingly brittle underneath. For governments, the implications are more corrosive. An environment where crises cannot be cleanly resolved erodes legitimacy over time. Policy becomes reactive, not strategic. Each intervention buys time rather than progress, and time itself becomes more expensive. Fiscal choices harden into political fault lines as voters experience higher costs, fewer opportunities, and diminishing returns from public action. The promise that the state can stabilize outcomes weakens, not because governments stop acting, but because action no longer produces visible improvement. Authority remains, but confidence drains away. Economic stability, once defined by growth cycles and recoveries, takes on a different meaning entirely. Stability becomes the absence of catastrophe rather than the presence of momentum. Systems are judged successful if they do not fail outright, even as living standards stagnate and productivity slips. This creates a subtle but dangerous shift in expectations. Households adjust downward, businesses delay, institutions optimize for endurance instead of innovation. The economy continues to function, but it no longer advances in a way that feels tangible to most people. The climax of this dynamic is psychological rather than financial. When actors across the system internalize the belief that nothing can be fixed quickly, behavior changes permanently. Risk tolerance collapses not in panic, but in resignation. Long-term planning gives way to short-term hedging. The future feels narrower, more constrained, less open to surprise. This is how an unstoppable crisis embeds itself, not through shock, but through adaptation to dysfunction. The resolution is not relief, but normalization. Markets adapt to low expectations. Governments adapt to constant stress. Societies adapt to diminished prospects. The crisis does not end. It becomes the background condition against which everything else is measured. And that is the most consequential implication of all. An unstoppable crisis does not just damage balance sheets or budgets. It reshapes how power is exercised, how trust is allocated, and how progress is defined. Once that shift takes hold, stability itself becomes fragile because it is built not on confidence but on endurance alone.